Hello and welcome to the weekly market metrics. I'm your host Sandeep Rao and we are in week 21 of 2026. We're almost at the end of May. Can you believe that? Well, this was again a strange but eventful week, not so much in the markets, but otherwise, yes. The Iran war uncertainty shows no signs of cooling down, oil price keeps climbing, and the rupee has now slipped to 97 to a dollar. What it really means is that everything we import gets more expensive: fuel, cooking gas, fertilizers, electronics, you name it. The cost of living creep is real, and ordinary Indians like you and me are now feeling it. Meanwhile, the Prime Minister was on a 5-nation European tour, perhaps good for the long term, but the optics back home were fairly complicated. And those who follow the bond markets are warning about rising yields, which simply means investors are getting nervous and want more return for lending money to the government. The broader markets, meanwhile, stayed put last week, largely closed flat. Tough times indeed. So with that, let's get started with what happened last week and what could happen in the coming one. Let's get to our usual market metrics, starting with the rate of change across indexes. Now, compared to last week, this week is mildly positive, with most of the indexes up in the range of 0.2 to 0.6, with an exception of Nifty Mid-Select, which is up 1.5% approximately. As we've said last week as well, MIDCPNIFTY continues to be the strongest so far, not just on a weekly basis, but across time frames as well. If you look at the year-to-date returns, MIDCPNIFTY is the only index with positive returns in 2026 so far, with Nifty, BANKNIFTY and SENSEX all down anywhere between 10 to 12%. Now let's move on and look at Nifty on different time frames, starting with weekly. Well, this week Nifty gained 76 points or 0.32% to close at 23,719, which is just above the 10-week SMA. However, Nifty is still trading below its 20 and 40-week SMAs on the weekly time frame. As you can see, the weekly range contracted from last week's 735 points to this week's 543 points. This is way below the 10-week average range, which sits at 826 points. In fact, over the past 6 weeks, the total range spans 1339 points, but the actual net movement in the index is just about 331 points. So it is safe to say that the index has gone absolutely nowhere in the past 6 weeks, despite doing all sorts of shenanigans. Last week's daily price action was so confusing. Let me show you why I say that. It was a constant fight between two moods. Markets have gone bipolar on a daily time frame. One day the market feels bold and paints a bright green candle, rushing towards the breakout zone of 23,800. The next day fear takes over, slapping down a heavy coat of red to undo all the progress. This week, Nifty was trapped in a small 500-point range from 23,300 to 23,800, unable to decide whether to push forward or give it up. Monday and Wednesday opened gap down, only to claw back and erase the entire gap intraday. Tuesday and Thursday opened gap up, only to reverse and erase all the gains intraday. And Friday opened gap up and held some ground, but still failed to cross about 23,800. 5 days of absolute whipsaws, ending right where it started. On the daily time frame, Nifty is yet again trading below its 21, 50 and 100-day EMAs, as well as the 200-day SMA. Moving on to the hourly time frame, well, the 50 EMA is acting like a magnet. Whether the index opens up or down, it always comes back to this line. It even closed the week right on it. And what this means is more pain for short-term trend followers, and it doesn't seem to be ending. I really hope this pain ends with a breakout on the upside soon. Talking about the Nifty weekly expiry, which happened on Tuesday, May 19th, it was one of the low-range expiries, with Nifty making a range of just 195 points, which was the second lowest for the week. The opening at the money straddle price was close to 150 points, which is decent given the realized move was not bigger than what the option prices were pricing in. The post 2 p.m. move of 150 points was a scalper's delight, but until then it was a relatively easy expiry for non-directional sellers. Do let me know in the comments how your expiry went. Now over to what to expect in the coming week. As I said earlier, Nifty is actually stuck in a narrow 500-point range between 23,300 and 23,800. It is unable to cross 23,800 even after trying twice last week. Maybe, as they say, the third time is a charm. Let's see. As per the EMAs, the 50 EMA is sitting right at 24,000 levels, and that should act as the first resistance. Now, if I look at the straddle premiums to gauge the expected range for the upcoming monthly expiry, which is on Tuesday, May 26, the Nifty at the money straddle closed at 286 points, down from 315 points last week, implying an expected move of roughly 1.21% on either side. This gives us an expected range of 24,000 on the upside and 23,430 on the downside. My overall bias for Nifty continues to remain sideways to bearish until 23,800 is taken out and then 24,000 as well. By taken out, I mean we need a close above these levels at least on the daily time frame. If I look at the directional bias of Nifty, BANKNIFTY, MIDCPNIFTY and SENSEX, the short-term and medium-term bias is negative for 3 out of 4 indexes except for MIDCPNIFTY, whose both short-term and medium-term bias remains positive. As we saw in the beginning of the video in the ROC chart, MIDCPNIFTY is the only index that is strong and in the green across timeframes. Moving on to India VIX, well, it fell 5% this week, closing in at 17.82 from 18.79 last week. That's a modest easing of anxiety in the market, which aligns with the mild recovery that we saw midweek. That said, at 17.82 is still in the elevated territory. Anything above 15 generally signals that market is on some sort of an edge. So while the fear has come down slightly, it hasn't really gone away. Moving on to the sectoral indexes this week. If we look at the top 5 TJI index performers, well, we have Telecom, QSR, Pharma along with API and CRAMS, then IT and ITAs and Defense. Quick note for those who are unfamiliar what API stands for, well, that's active pharmaceutical ingredients, basically the core chemical compounds that actually make a medicine work. CRAMS is contractual research and manufacturing services, are essentially companies to which global pharmaceutical companies outsource their research and productions. So both these category of firms are actually behind the scenes backbone of the pharmaceutical industry in India. Comparing to last week, well, Telecom is back again, and on a year-to-date basis, it continues to stay positive, so something is clearly cooking over here. Defense again has been on an uptrend for more than a year now and shows no signs of slowing. These two sectors are the ones I'd keep a close eye on for now. The rest look like blips at the moment, not something worth chasing yet. Talking about pharma, well, as a broader pack, it has held up reasonably well relative to the market, which is a positive sign. And if you're looking to pick stocks within pharma, stick to the larger names for now. The smaller pharma companies and API and CRAMS companies tend to be more volatile and less forgiving in uncertain macro conditions like these. Shifting to the 52-week high view, the number of indexes trading close to their highs has dropped further compared to last week, which tells us that market breadth is narrowing, fewer and fewer sectors are participating in any upside, and that's something to watch for carefully. That said, a few names do stand out. The bearing space is at the top of the list and it has been quietly doing well for the past 6 months now, so clearly there's something going on and it's worth digging into. Pharma is something that we just spoke about. Communication equipment is another one worth putting on your radar. Defense, as we've discussed, continues its now year-long uptrend. Metals are holding up on the back of the broader global metals trend. Also, dyes and pigments is continuing from last week. Some of these are carryovers from last week like pharma, communication equipment, and dyes and pigments is also continuing from last week. I would say continuity of these indexes across weeks is actually a good sign. It suggests these aren't just random one-week bounces, but something with a bit more staying power. One thing to keep in mind when looking at these sectors, always check them across multiple time frames and pay attention to the breadth within each sector. And that's precisely why we use the equal weighted indexes here rather than the market cap weighted ones. a market cap weighted index can look healthy simply because one large stock is doing well, masking the weakness which could exist elsewhere. Equal weighting gives us a truer picture of how the sector is actually behaving across the board. That's pretty much it on the sectors this week. Moving on to commodities. On the daily time frame, gold M futures stayed above the 50 EMA throughout the week without giving any major moves. Similar is the story for silver. Silver M also stayed above the 50 EMA without any major moves this week. Overall, a very tepid week across precious metals, copper, crude and natural gas. Not much happening on the weekly time frame. But yes, if you zoom out to the year-to-date and 6-month numbers, that's where the real story is. Whether it's carnage or in some cases the extraordinary gains, that's what becomes apparent on these time frames. So that's pretty much it for commodities this week. So overall, in summary, the markets closed largely flat last week against a tough macro backdrop of climbing oil prices and the rupee slipping to 97. In terms of indexes, MIDCPNIFTY remains the single positive outlier in 2026, showing absolute strength, while NIFTY, BANKNIFTY and SENSEX remain stuck in a correction, down 10% to 12% on a YTD basis. NIFTY specifically is trapped in a very tight zone, consolidating below all major daily moving averages. The index continues to face a brutal directionless chop, doing all sorts of shenanigans every single day but going absolutely nowhere. For me, if I look at it, the overall bias continues to stay sideways to bearish. If I had to talk about the monthly expiry coming next week, well, the straddle has cooled to 286 points, pricing in a 1.21% expected move with a resistance at 24K and a support at 23,430, and a market holiday squeezing expiries into a back-to-back doubleheader on Tuesday and Wednesday. Make sure you keep your position sizing tight. The idea is to survive at the moment. Moving on to what caught my attention this week, well, I've got two interesting recommendations for you. One is about the state of Rupee and the other is about the fascinating story of Vanguard. The first is an Indian Express piece titled "Rupee is more than a measure of price, it's also a barometer of credibility" by Sachidanand Shukla. If you've been trying to make sense of the rupee slide, this is a good place to start at what's driving it, what it means for the broader economy, and why simply letting it fall may not be the greatest of the ideas. The second is a podcast episode of Acquired on Vanguard. It's the story of the legendary Jack Bogle, how he starts from a genuinely humble beginning, almost brushing poverty, to building one of the largest mutual funds in the world. What makes it especially fascinating is how the entire idea of passive investing was scoffed at when he first proposed it. And today it's the foundation of how most sensible investing is done. For me personally, it was humbling, inspiring, and I would say it's a must listen if you care about where modern passive investing came from. As always, you'll find all the links in the show notes. Now over to the events to factor in for the coming week. Well, next week is packed with monthly expiries across NSE and BSE indexes. Since Thursday, May 28 is a market holiday on account of Bakri Eid, it pushes all the usual Thursday expiries ahead. So what this does is it sets up a massive double header of back-to-back expiry days on Tuesday, May 26, where NSE's NIFTY, BANKNIFTY and MIDCPNIFTY monthly contracts will expire. And then on Wednesday, May 27, BSE's BankX and SENSEX will have its monthly expiries. Oh yes, there's another new FOCIT or Focused IT options contract on BSE which tracks IT companies. Do check it out if you would like to take positions on the IT index, but be very careful with the liquidity. Other than that, there are no major known events, and with that, I wrap up this week's weekly market metrics. If you find this series useful, please don't forget to subscribe to the channel, and yes, do share it with your friends. Until then, stay curious, stay steady, and enjoy your weekend.